Hello, and welcome to Financial Fluence, where we'll teach you the most up-to-date strategies and tricks for making money online. Don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Also, don't forget to leave a comment down below. In this video, we'll talk about why rich people continue to use hedge funds even if they are terrible investments. Buffett bet $1 million in 2008 that a hand-picked collection of hedge funds couldn't beat the S&P 500 index over 10 years. Buffett won the bet in 2018 and received $1 million, which I'm sure was a very big deal for him. This showed a major flaw in the financial industry: actively managed funds' incapacity to outperform the market. Only a limited number of funds have delivered their clients larger returns than a more conventional investment strategy. You must be an accredited investor to invest in hedge funds. Accredited investors must have a stable income of at least $250,000 per year, or $300,000 per couple in the US. Accredited investors must have a net worth of $1 million, minus their primary home. You can also be an accredited investor if you're a director, CEO, or general partner of an unregistered business. This helps people invest in their own startups, because the SEC wants to prevent unscrupulous financiers from taking advantage of simple investors. You must be an accredited investor to invest in risky assets. Even accredited investors can't invest in most hedge funds. Most hedge funds require a $100,000 to $1 million minimum investment. Bridgewater's investment minimum is $7.5 million, and yearly fees can reach $4 million. Additionally, you must receive an invitation to invest in the fund, a distinction usually reserved for those with an investable net worth of $7.51 billion or higher. But wealthy individuals of this caliber are often not stupid. So why would they put money into hedge funds, since these funds have typically underperformed a more straightforward investment strategy? Investing is certainly a wise choice if you do launch a $1 million business and begin to make more money than you know what to do with. Investing intelligently may prepare you, your children, and the children of your children for a life in which they only work if they choose to. Businesses do not last forever. There are several options available to you. But historically, if you want to be secure, bonds have been your best bet. However, with interest rates where they are now, that isn't a very appealing choice. It's difficult to build generational wealth on a 10-year-old platform like cryptocurrency. Real estate and stocks are the most frequent investments. They've been around since capitalism began, are popular, and make good money. If you have millions or billions of dollars, getting in is easier than ever. Hedge funds exist too. On the surface, they appear to be stock market intermediaries, a middleman who drains profits. Where is the value in this? Well, assuming this is an issue is the first mistake. Buffett's $1 million bet may have tarnished hedge funds, but it didn't teach investors anything new. These funds underperformed. So what? Does the market's outperformance over bonds and real estate suggest bonds are bad investments? No, of course not. They are simply unique. The second error is believing that stock market investments are the only thing hedge funds do. While not all of them do, some of them do. They don't invest like most people. We buy stocks because we expect them to appreciate. If a stock is expensive and expected to decline, we may sell it. Some of us try stock derivatives like options, but by then we know it's legalized gambling. Whatever we do as individual investors, we're betting on a stock's price. The usual financial advice is to invest in affordable index funds and never sell them, since most companies improve in value over time. Some years will be better than others, but if you keep a broad portfolio over time, you'll profit. 99% of people should accept this advice. When paired with real estate, Bitcoin, and other alternative assets, it can be an effective way to accumulate wealth. The 1%, on the other hand, require something more. They require wealth that grows regardless of market conditions. Investors say good hedge funds shouldn't take market risk, investment risk caused by market downturns. Almost all publicly listed stocks are exposed to market risk. Even if the underlying companies are performing well, the market stocks will plummet. The easiest approach to removing the risk is to wait it out, which is why long-term investing is recommended. Market risk can be avoided. Let's look at a simple example. According to a hedge fund, Steam will monopolize PC and console gaming. With this information, they'll buy Steam shares and short and equal valued shares in GameStop. If the market drops, their short bets on other companies will offset their stock losses. So, they've hedged their bets. If Steam announces that they will partner with Sony, Microsoft, and Nintendo to release all video games, their stock price will climb and they will profit from the news without market risk. Things can still go wrong. If the online meme lord favors GameStop, the hedge fund will lose money. But it is irrelevant since it is only ordinary speculative risk, which is irrelevant as long as it is not market risk. So why is eliminating market risk so crucial? Because having their own firms and other investments exposes wealthy people to that risk already. Because the majority of conventional investments are still associated with the stock market, it is exceedingly difficult to diversify away from market risk. Real estate values would probably drop in the event of a stock market crisis and vice versa. Rich people are interested in return streams with no correlation. The market should be doing well if their hedge fund is having a bad year, and vice versa if the market is down. Surprisingly, diversifying one's portfolio with unrelated assets can be more effective than sticking with whatever offers the best long-term average returns. Although the math underlying this idea is challenging, it all revolves around a concept known as dollar cost averaging. Dollar cost averaging is based on the premise that investors will always make regular, fixed contributions to their portfolio, regardless of the state of the market. They will make the same investments whether the market is up or down. This means that the investor automatically fulfills the buy low portion of the investing golden rule by purchasing more assets when the market is down than when it is up. When assets are uncorrelated, something constantly performs well while another performs poorly, allowing dollar cost averaging to be fully used. Because most investors invest for a single goal, such as retirement, the breadth of their investment is less important than the breadth of their time horizon. Rich people prefer to have quick access to their money so they can seize opportunities as they arise. If a billionaire is offered the chance to invest in the next Facebook, they won't want to pass it up because they don't want to sell their holdings while the market is down 30%. Hedge funds are still in existence for yet another reason. Wealthy people like to believe they can predict winners. Hedge fund investing is more like investing in a small business than it is like investing in the stock market. Like most hedge funds that underperform the market, most firms fail. But if you were fortunate enough to invest in the Medallion Fund when it was just starting, you would most likely be a multi-millionaire today. That alone serves as sufficient motivation for many wealthy individuals to send a few checks to up-and-coming hedge fund managers who have a solid investment thesis. Hedge funds are not quite as popular today as they were in the 1980s and 1990s, but among billionaires, private equity is now trendy. However, there is still a reason why these companies exist. They provide a very particular kind of service to a very particular kind of person. And that's it for today's video. If you learned something, give it a like and share this video with a friend or two who could use the advice. With that said, thanks for watching and I'll see you in the next one.